Hello dear students, my name is Jyoti. Earlier we had discussed about the meaning, patterns, factors affecting and importance of capital structure, and today we will discuss about the theories of capital structure. So different authors have propounded different theories of capital structure in order to explain the relationship between capital structure, value of firm and cost of capital. So the theories of capital structure can be divided into two categories such as relevant theory and irrelevant theory. So according to the relevant theory, capital structure affects the value of firm and cost of capital. Net income approach and traditional approach supports the relevant theory, while the irrelevant theory explains that capital structure does not affect the value of a firm and cost of capital. Net operating income approach and Modigliani and Miller approach supports this theory. So let's discuss about the first theory of capital structure, that is net income theory. So this theory was propounded by David Durand, and according to this theory, debt financing is the best option for financing the business operation. So a firm can minimize its cost of capital and increase the value of firm by using debt financing, because debt is considered as a cheaper source of finance and interest on debt is also a deductible expenses for income tax purpose. So let's discuss how cost of capital and value of firm can be calculated in net income approach. So in order to calculate value of firm, we need to add market value of debt plus market value of equity share capital. So V denotes value of firm, D denotes value of debt, while S denotes value of equity share capital. So in order to calculate S, we need to divide earnings available to equity shareholders with equity capitalization rate. And if we divide EBIT with V, we can calculate the overall cost of capital. EBIT means earnings before interest and taxes. This diagram of net income approach also shows that if proportion of debt is increased in the capital structure, then overall cost of capital will decrease and value of firm will increase. Then the next theory is net operating income theory. According to this theory, capital structure of a firm does not affect the cost of capital and value of firm. So overall cost of capital remains same irrespective of the method of financing. So this theory presumes that business risk remains constant at every level of debt equity mix, whether it is 50-50 or 80-20 or 30-70. So from this theory, we know that cost of capital remains same at every level of debt equity mix. But what is the main reason behind it? So the main reason behind it is, as we know that debt is considered as a cheaper source of finance, but increased debt may also increase the financial risk of shareholders. So the benefit of cheaper source of finance can be offset by increased cost of equity. So let's discuss how cost of capital and value of firm can be calculated in net operating income approach. So when we divide EBIT with overall cost of capital, we can calculate value of firm, and market value of equity can be computed by subtracting market value of debt from the total value of firm. And formula to calculate cost of equity is EBIT minus interest divided by V minus D. This diagram of net operating income also explains that cost of capital remains same irrespective of debt equity mix. Now let's discuss about our next theory, that is the traditional approach. So according to this theory, optimal capital structure can be reached by a proper debt equity mix. As debt is considered as a cheaper source of finance, so initially cost of capital can be decreased by using more debt financing, but beyond a certain point cost of equity starts increasing, because increased debt may increase the financial risk of the equity shareholders, and then there comes a stage when cost of equity cannot be offset by the advantage of low cost debt. So overall cost of capital decrease up to a certain point, then remains constant, and beyond a certain point it starts increasing. So our next theory is Modigliani and Miller approach. This theory was propounded by Modigliani and Miller, and it also supports the irrelevant theory. According to this theory, cost of capital is not affected by the value of firm. So we know that debt is considered as a cheaper source of finance, but increased debt may also increase the financial risk of shareholders, and the benefit of cheaper source of finance can be offset by increased cost of equity. Moreover, due to arbitrage process and personal leverage, two identical firms can also have same total value because investors will sell the overpriced shares and purchase underpriced shares, and this will continue until both identical firms will have the same market price. So there is no difference between value of levered and unlevered firm. Modigliani and Miller approach proposition with taxes. So in 1963, Modigliani and Miller recognized that cost of capital and value of firm also affected by capital structure and due to availability of interest charges for income tax purpose. So there is a difference between value of levered and unlevered firm. So debt can also provide the tax benefit, and up to a certain limit it adds value to a company. There are certain formulas in approach which can be helpful in calculating value of levered and unlevered firm. So let's discuss how we can calculate it. So value of levered firm can be computed by EBIT into 1 minus T divided by equity capitalization rate, while value of levered firm can be calculated by adding tax into amount of debt with value of unlevered firm. Our next theory is pecking order theory. So pecking order theory suggests that when a firm needs funds, then it should rely on internally generated funds. And if internally generated funds are not sufficient, then it will move to debt. And if debt financing is also not sufficient, then the firm finally moves to raise finance through equity shares. This order of preference is so defined because the internally generated funds have no issue cost and the cost of new equity issue is the highest. So these are the theories of capital structure.